Hello, welcome back to Damola Talk Finance. And in today's episode of today's video, I'll be showing you 10 things you can actually start investing in. 10 good things you can actually start investing in. So what you do for me is that you go grab a cup of coffee and just get set, and I'm going to be showing you all this information all for free. Get a pen, get a book, and start writing it down, because I'm going to blow your mind of some easy things you can actually start investing in. And of course, you have the money to start investing in them. Alright, go grab a cup of coffee and I'll see you on the other side of this video. Cheers. Alright, welcome back. So I promise you I'm going to be giving you 10 things you can actually start investing in. 10 good things. The first on the list is cash. The first on the list is cash. Have you ever heard of the statement saying cash is king? Yes, cash is actually king. You may wonder why, Mike, you're going against yourself. Why would you say that I should invest in cash? I thought you said keeping your money without investing it is not a smart decision. Of course, the reason why I say cash is king, or cash is also an investment, is because when you have some cash reserve, you can be able to take advantage of some opportunity when they come. For instance, investor like Warren Buffett, they have $189 billion in their cash reserve. Why is it sitting down there? And guess what? They don't even pay dividend for their shareholders. So they're keeping that money because when an opportunity comes, they want to take advantage of it. They want to grab it to the extent that nobody will have the opportunity to invest with them because they have the cash. That's why I said cash is king. But the smart thing to do is, when you're reserving this cash in your bank, or when you want to reserve this cash for future opportunity that may arise, I would advise you save the money in a high yielding account, high yielding savings account. For instance, like Robinhood does it. They give 5% APR on your savings on cash that you're not investing. Trading 212 also do that. I think about 4.5 or 5% APR on cash that is not invested. So that will cover for the sake of inflation. And of course, as your money is lying down for you, the money is also yielding out income. So you see that that's also an investment. So the first investment is cash. Cash is king. Now the second investment you should also invest in is real estate. Real estate. We have different kinds of real estate investment. You can invest in residential real estate, commercial real estate. There are different kinds of real estate. Now, the reason why you're investing in real estate is because real estate, when you have a good rental property, it has the ability to give you what we call rental income, residual income. You just do a little effort and the property keeps paying you at the end of the month. So you are making residual income from that property. So it's called rental income. Now, you should also look into different strategies of real estate. I mean, there are different strategies that is coming up now. We have HMO, which is house of multiple occupancy. It means you have a building, you bought a property, and you renovate the property to the extent that a lot of people can be able to stay in that property. Let's say it's just like a single unit, that's it, ensuite toilet and bedroom unit, and like a general kitchen that everybody can use. There are requirements from the council, depending on where you're staying, if that is approved in that area. But we have HMO, house of multiple occupancy. We also have BRRR, it's called like buy, rehab, or refurbish, rent and refinance. Is like a strategy in property. Well, you have buy to let. You can buy a property and decide to let the property out to the people that will be renting the property. So there are different strategies. So you should go well and make your research. So you should look into that if that's what you're interested in doing. Real estate investment is also a type of investment that you should invest in. The next is shares of companies. Yes, you can buy the shares of publicly traded companies. These are big companies that sell their shares out to the public. So you can also invest in Apple. You can invest in Netflix. I mean, instead of you sitting watching Netflix, you can be watching Netflix and you feel proud. When you give that monthly subscription, you feel like, no, I'm investing in my business. So you can own some part of Netflix, you can own some part of Google, you can own some part of Greg's, you can own some part of McDonald's, and you can own some part of Chipotle, you can own some part of Dangote Cement and all of that. So you have a share in these companies. So I want you to look in this aspect also. When you want to invest in the shares of company, are you investing for the sake of making dividend? I mean, you want to be getting a quarterly returns. After every quarter, is something you want to be paid for investing in that company. Or you just want the value of your capital invested to increase. I mean, you bought the shares for, let's say you bought it for $30, and after 1 year you want the share value to have increased to about $35 or $40. So if you bought about 1,000 shares, then you know that multiple of what it is. Now that could be your horizon. Some people want to invest in publicly traded company for the purpose of making dividend. So if that's your choice, you should make research on companies that actually pay dividend. And I've done a video about that when you're investing on how to own the world. You can check my channel and watch that video. You're going to learn something from there that you can actually put into practice. Now the next is bond treasury bills. Bond treasury bills. So you can invest in bonds also. So bond is like we have corporate bonds. Now corporate bonds, from the word corporate, corporation, publicly traded companies. Now there are 2 ways or 3 ways the company can actually raise funds. They can go to the debt market, which is the bond market. So they want to raise money for a particular project. For instance, let's say they need $100 million for a particular project, and they don't want to sell the shares of their company, and they don't want to borrow from the bank. What they do is that they go to the debt market. So we want to raise $100 million, for instance, and we'll pay back this money in 3 or 5 years. So it's going to be like a 5-year corporate bond, for instance. So it's sold out to the members of the public like you and I. So you can decide to buy those bonds, you can decide to buy those bonds and you invest in this company. So in quarterly period, they pay an interest to you for investing in those bonds. So that's the reason why you're investing in it. So you're paid a quarterly amount of money, like a premium for investing in bonds, right? So the next thing I said is treasury bills. So government can also sell out bonds. So government are having a project that they want to carry out, they can decide to sell government bonds or treasury bills, right? So another thing I want you to look into this for the sake of clarity is that when you're investing in bond, you want to look at the interest rate. The reason being is because interest rate and bonds go in opposite direction, and this is what I mean. Now let's use for the normal balance of demand and supply. Now when the price of a stuff or the price of this phone is cheap, you know that a lot of people want to buy it. Let's say it's a good phone and the price is cheap, so a lot of people will want to buy it. But the moment the phone start becoming very expensive, the demand for that phone is going to drop. Now there are some cars that you see, like let's say a Volkswagen or something like that. It's not expensive and you have a lot of people buying that car. That's because the car is good and it's not expensive. The phone is good and it's not expensive. So let's invest in the phone. Let's buy the car. You get my point? So now coming to bonds, when interest rate is high, the price of bond tend to drop. The reason being is because there will be less demand for it. So let's say you bought a bond in 2023 and the interest rate in 2023 was 5%. The interest rate by the Fed or by the Bank of England or whatever financial organization is moderating your interest rate in your country. So they place the interest rate at 5%, for instance, right? And in 2024, they are selling another bond and the interest rate has reduced to about 3%. You get my point? The interest rate has reduced to about 3%. Remember, if interest rate rises, the demand for bond drops. The demand for that particular bond drops. So in other words, people will want to go for the one that is a bit cheaper. So the one that is expensive, which was at 5% interest rate, the demand for it is going to drop. So as the demand for that bond drops, the value of that bond drops, the price of that bond drops, and people will start moving to the one that the interest rate has dropped to 3%. The demand for it will now rise. So the same thing applies. So as interest rate is rising, you definitely know that the price of bond is reducing, and as interest rate is dropping, the price of bond is increasing, because the higher the demand, the higher the price, the lower the demand, the lower the price, the higher the demand. You get my point? All right, so bonds, that's one thing I want you to look into bonds. The next point is that, by the way, if you don't understand what I've said, please just comment below that you want a video that will address bond, and I'm going to do that. And I believe you've learned something from this video so far. So please just do me well to subscribe on this channel. We have a goal of getting to 5 million subscribers. Don't laugh about it. 5 million subscribers, and you and I is going to do so. So give your comment like, share, subscribe so that you can help the algorithm to grow the channel, and also click on your notification bell so once I release the video, you'll be the first person to receive it. All right, back to our investment. So the next is index fund and ETFs. You can invest, remember we talk about shares of company, you can also invest in index fund. Index fund is like a basket of companies. For instance, you have S&P 500 index fund. It's like the Standard & Poor's top 500 companies we have in America. So instead of you investing in Google or Tesla or Nvidia, or invest in Procter & Gamble, or invest in Chipotle, or invest in McDonald's, you can just decide to invest in a basket of company. So because it's possible that you invested in Tesla, and that year Tesla did negative 5%. So it means your investment value has actually depreciated. But when you invest in a basket of company, you are getting the average value of that basket. So you have S&P 500, we have S&P 500, we have NAS 100, we have Dow Jones 30. So these are different indexes. We have FTSE 250, we have CAC 30. We have different indexes that you can actually invest, depend on the country you're coming from. Every country that has a stock market have an index. So you can also track the performance of that index and invest in it. Mind you, the Standard & Poor's 500 have returned an average of about 8 to 10% in the past 20 years. So if you're investing in it, it means you have a guarantee of making at least 8% to 10% return on investment averagely. I think that's a good thing to do for yourself and for the future. The next is ETF. I said index fund and ETFs. Index and ETF are almost the same thing. It's just that ETF, electronic traded funds, is just that ETF, exchange traded fund. It's just that ETF can easily be traded. In other words, the way you buy shares of company, the way you trade gold, the way you trade currency, forex market, you buy gold, you sell, you buy gold, you sell GBP, you buy USD, you sell ZAR, different currencies. You can buy and sell currencies. That's how it works for ETFs. But in index fund, it's a bit difficult for you to be trading index fund because it functions by tracking an index of a company. But in ETFs, ETF can easily be traded in a day. So that's the difference between ETFs. But they are also a form of investment that you can invest. You can invest in ETFs, you can also invest in index fund. Now, I want to talk something about shares also. I forgot to mention that. Shares, which is the third point. Shares and REITs. I want to talk about REITs. REIT is called Real Estate Investment Trust. By the way, if you're investing in real estate, you can also invest in Real Estate Investment Trust. Now I'm talking about real estate, which is the second point. Real estate investment. Just in case you say real estate is very expensive and I don't have that huge amount of money to invest in real estate, you can actually invest in Real Estate Investment Trust. So you invest in this company and they use your money to invest in properties. That's almost a similitude of you owning a property. You might not have the huge amount of money to buy a property, but you can start investing in a company that will use your money to invest in property, right? That's for real estate. Now the second point, which is shares I was talking about. Now we also have real estate investment trusts that are publicly traded company. So one thing they do is that with real estate investment trust is that they give 90% of their income, rental income, they invest in properties. So they have rental income from this property. So 90% of what they make is paid to their shareholders as dividend. So that's a bonus and a tip for you. If you're investing in REIT, whether you're from Africa, Nigeria, from London, England, America, 90% of what they make as rental income is paid to you as a dividend if you invest in the company. So that's what I'm talking about in shares and REITs. So you should look for companies that are publicly traded that is called Real Estate Investment Trust. That would be a good one for you. Make your research. It's just a recommendation, not a decision for you to take. Now the next point is commodities. Commodities are things like gold, silver, wheat, barley, coffee, cotton. You can invest in commodities. Yes, there are some asset class like gold that do well when there's interest rate, that interest rate is high. They do very well because a lot of people, they want to hold themselves. When there's uncertainty in the economy, they want to put their money in things that they can be able to be sure that has a stability, like gold, like silver. So you should make your research on investment in gold. We have companies that are publicly traded that invest in gold. We have Barrick Gold. You can buy the shares of this company. You can also buy physical gold. Yes, you can buy physical gold, or you can buy the shares of gold. You can also buy gold, but there are companies that help you to store them. So you may not have the space to store it in your house, but you have companies that store them for you. They may have little fees, but that's something you can be able to cover if that's your choice. The next point, which is the 7th point, is art, wine, and carbon capture. Art, A-R-T, art, wine, W-I-N-E. Some people invest in wine. Yes, good quality wine. The value of this wine increases over time. Remember wine, I was told, I don't know much about it, but I was told that wine, the longer they last, the sweeter they become. That's a good investment strategy, you should know. So it means that the value increases over time. So when you invest in wine, your return on investment can actually grow over time. Also in art, like frames that is done by, let's say, good artists in the 1980s or the 1870s. Those are art collections. Some people collect art. That's the business they do. Some people collect antiques. Old cars that are vintage, and they sell them later on in the future. They're very, very expensive. So it's an investment opportunity if that's what you're looking into. The next point, which is the 9th point, which is the 8th point, is cryptocurrency. Sorry, I talked about carbon capture. Carbon capture is investing in green energies. So there are stocks that invest in carbon capture. If you're interested in sustainable investment, so you should be looking into carbon capture companies and invest in them. Of course, because the whole world is actually tilting towards a net zero world. So companies that are already fixing their investment strategies in this line, you should be participating in them, because that's where the world is actually going into. So the earlier you get into it, the better it is for you. Now, cryptocurrency. I know some people don't believe in cryptocurrency, but I do believe in cryptocurrency. But, this is my but, you don't put all your whole basket in cryptocurrency. Just a little stake. Why? Because it's very volatile, and you have the opportunity to make good return on investment for it. So instead of you putting a lot of your money or your asset into cryptocurrency, what if it goes the other way around? It might go north, it can come south. If it goes north, good, you make good money. But when you invest a little amount of money, you can actually make good returns on it. And when you are losing, you can lose little, because that's a little fraction of your wealth. But if you're investing a lot of your money on it, I know I talk about taking risks and all of that, but smart risks. Cryptocurrency is volatile. You should be careful if you want to invest in cryptocurrency. The next, which is the 9th point, is you can start your own business. Yes, you can start your YouTube channel. You can start selling something online. You can have an idea, just launch it. You'll be surprised what that can turn into, right? You'll be surprised what that can also turn into. Now, the next point is intellectual intelligence, or intellectual property. You can invest in your knowledge and people can begin to pay for you. Meaning you have a course that you sell out and people pay for that course. Meaning you write a book and you're being paid royalty for different publication company. Meaning you write a song and Universal Music is actually paying you for singing your song, because your song is good and everybody is interested in playing your song, and your song is all over the way. Everybody's just interested in that song, so they can pay you for your intellectual property. That's why I say you should build your mind, read books, develop yourself. You understand me? All the things I'm saying was because I've invested in myself. Yes, it's what I'm passionate about, but I've invested in myself that I can be able to deliver such value to you. So when you invest in yourself, people can pay you to speak to them. People can pay you to write books. People pay for your course. So those are also a type of investment that you should invest in. Finally, and in conclusion, I want you to know this. You don't necessarily need to own these 10 investments. As little as 1, 2, 3, but you can start. I don't owe everything, but it's my goal and my objective to own all of it and even more, right? Because we have a lot of investment, but this is like the major investment that we have. So as little as, even if it is shares, even if it's an index, just take action. with as little as $1, you can begin to start investing in index fund, in shares of company, because we have these fintech companies and these brokerage companies that give you fractional shares. So you don't need to have $300 to buy a share of the company. As little as $1, you can buy a fraction. And guess what? It can grow. And that's how you begin to test the waters and you begin to invest more and more and more. So that's my conclusion for you. I'm happy you're watching the video, but much more important is that you take action. I want to get testimonies from you that these things you're learning, you're putting them to practice and you begin to see returns on them. And you'll be surprised how you can grow financially by just these simple things. Please do well to like, share, subscribe, and also comment so that this channel can grow. You and I is going to make sure this works together. All right? Thank you very much. And until you see my next video, please don't forget to always stay green. Cheers and bye.